Hello, this is Tim Congdon. I'm chairman of the Institute of International Monetary Research at the University of Buckingham. This is the first monthly presentation of 2020. I'm going to be talking about global monetary trends and what they mean for the world's economy. But this particular time, I want to develop some ideas which may be a bit difficult and controversial to follow. Anyway, at the end of last year, I emphasized the acceleration in the growth of money in the United States. And since America continues to account for about a quarter of the world economy, I used that acceleration of money growth to argue that there wouldn't be a recession. And indeed, the first half of 2020 ought to see trend or even perhaps above trend growth in the United States. This is very much against the kind of view emerging from reading newspapers, but it fits in with the buoyant stock market and the active housing market in the USA at the moment. But there's been an objection to this. It's been pointed out that the growth of bank credit in the sense of bank lending to the private sector hasn't been particularly buoyant in America in recent months and quarters. And I did indeed emphasize that the main reason why US money growth picked up in late 2019 was that they had this very large budget deficit, about $1,000 billion, that was being financed from the banking system and in that sense being monetized. Now this debate about is it money that matters to the economy or is it bank credit by itself that matters goes back decades, even centuries, and I probably won't resolve it on this particular occasion, but I want to just say one or two things about it. And I want, in my view, to say that it's money that matters, not bank credit by itself. Now, there's other things to say here, but that's my main message. I'm saying will be somewhat controversial. I need to give that health warning. And just to make it a little bit more accessible, I'm going to bring in an elephant, a baby elephant, and a mouse. Anyway, the way that many economists think about the determination of spending and national income is through something called the income-expenditure circular flow. And I'm just going to read this quote from a chap called Christopher Dow, a book written a bit over 20 years ago. Interpretation of events, trying to understand the economy, cannot depend on an unstructured observation. We've got to have some theory. It has to be based on assumptions about the causal structure of the economy. Total demand is defined in terms of real final expenditure. Its level, in the absence of shocks, is determined by previous income. I receive some income and I spend it, determines spending whole economy. The result of the spending is output, in the course of producing which income is generated. Income in turn goes to determine demand in the subsequent period. So it's a kind of circular flow that just goes round and round and round, period after period. Now, this idea set of ideas is, I suppose, most economists' default model of how the economy works. And obviously, it's very important in all this to identify these shocks, as Christopher Dow calls them. What is it that disturbs this circular flow? And one possibility is credit. You see, obviously, if I borrow from my bank, then I can spend above income, certainly for a particular period. And if lots of borrowing is going on, if lots of credit is being extended by banks, then perhaps expenditure can be above income for the economy as a whole for one period, and the next period, spending creates output, that means more income, and so on. So the strength or weakness of bank credit is very important in this kind of story. In fact, let's just think a little bit more about all this. There are textbooks which put this circular flow at the absolute heart of the story of national income determination and macroeconomics. Perhaps the most influential current textbook on macroeconomics is by a chap called Greg Menke in American. His textbooks on macroeconomics, now 8th, 9th, 10th edition, I'm not sure which exactly. I'm going to quote from the 8th edition. He has this chart of the income expenditure circular flow, and he says that this figure 2.1 illustrates all the economic transactions that occur between households and firms in the economy. So the income expenditure circular flow, according to Greg Menke, is all the economy. No, it isn't. And the reason for this is that if you look at the total value of payments in an economy, it's very much higher than the value of payments inside the circular income expenditure flow. People buy and sell existing assets. They buy and sell, for example, houses. Now, suppose I buy a house that was built in 1930. Okay, that's a payment, that's a transaction, it goes into value of transactions. It's clear that the incomes that were paid to bricklayers and plumbers and so on to make this house were paid in 1930. They haven't been paid in the last 6 months or a year. They're not part of current spending. They're not part of this year's income expenditure circular flow. And in fact, all of the transactions in assets are not part of the income expenditure circular flow. The question then is, how large are the transactions in assets relative to the income expenditure circular flow? Well, it varies from economy to economy, and I can only put together figures for the UK, which is the economy I understand most. But in 2018, the value of total transactions was about £90 trillion, 90,000 billion pounds, all right? The value of national income was much less. It was about 2,100 billion pounds. Now, it's true that income is spent, and spending was the output. So the income expenditure circular flow is 3 times the 2.1 trillion. It's 6.3 trillion. But the value of all transactions is 15 times the value of the transaction inside the circular flow. So contrary to Menke's textbook, the income expenditure circular flow is not all the economy. There's a lot of transactions outside the circular flow. Okay. Now, the next question we'll think about is trying to sort out the importance of money relative to bank credit. That's what I'm currently concerned with. Most bank credit transactions, most new loans, are to finance the acquisition of existing assets. The great majority of loans to the household sector, to people, are to buy houses. They're far more important than loans to buy cars or to buy consumer durables, although in fact, again, the market in cars is a very big second-hand component that's larger than, in fact, in new cars. The great bulk of loans from banks to buy houses are in fact to buy existing houses. They are not part of the current the transactions that go into the circular flow. So the first round effect of loans to buy houses, of this very large part of bank credit, the first round effect isn't registered in income expenditure circular flow at all. Just get this clear, that in that sense, bank credit cannot be relevant to determination of income expenditure in the current period, in this first round. All right. Yeah, there may be some money balances created by new bank loans, I know that, and then the money balances affect spending in later rounds and all the rest of it. Fine, but then we're back to money being the variable that matters. Okay. Let's then ask ourselves, so if we try to think about the relative size of the circular flow relative to all transactions, it's all transactions that's the elephant in the room, and the circular flow is little baby. All right. Let's then also think about new bank credit to the private sector. A new bank credit matters because it creates new money. If a bank extends a new loan on the asset side of the balance sheet, there's a new deposit on the other side. And then the money goes round and round and round. Velocity of circulation is very high, multiple of the amount of money. But how large is bank credit by itself? Well, in 2018, as I said earlier, all transactions was 90,000 billion pounds in the UK. The value of the GDP was 2.1 trillion. Income expenditure circular over 3 times that. And bank lending to the private sector was 77 billion, less than 0.1 trillion pounds. Now, I put it to you that relative to the elephant in the room, quantity of money, bank lending to the private sector, new bank lending was a mouse. Didn't matter at all. If you want to understand what's happening in the economy, what's critical is the quantity of money and how much money agents want to hold relative to transactions, relative to their spending, relative to their portfolios. It depends, in other words, on what economists call technically the properties of the money demand function. There's a lot of nonsense spoken about the importance of credit in macroeconomic analysis. What I've said today has been quite controversial. I've basically dismissed new bank credit as of no importance at all, except to the extent that it creates money. And then it's very important. The fact that in the second half of 2019, bank credit to the private sector was rather weak in the USA does not mean that we can then ignore the message from the acceleration in money growth. The acceleration in money growth is what's really important to the economy. And I stick to my view that in the first half of 2020, the USA is more likely to see trend or above trend growth than it is to see a recession. And all the recession talk in the newspapers and elsewhere is going to be wrong. There may be a slowdown in money growth in coming months. Well, then we have just to watch the figures and draw conclusions from that as we go through the next few months and analyze the picture. Thank you very much. Thank you.